Ladies and gentlemen, welcome back. I hope everyone enjoyed their lunch. The first session after lunch is, I think, always very tough, but please don't worry. We have a very interesting and intriguing session prepared for you. I think it's a topic that everybody is very much interested in, and that is how to finance green growth. The moderator for this session is Mr. Dominic Warhay, the Senior Director, Head of Environmental Initiatives at the World Economic Forum. His responsibility includes the organization's climate change and water security programs, and he also leads development of the World Economic Forum's overall agenda on climate change, water, and other sustainability and resource management issues. He has degrees in economics and environment from Cambridge University and UCL. He is also an international fellow at IIED and advises a number of organizations in the water and climate change area. So, ladies and gentlemen, it is my pleasure to introduce to you Mr. Dominic Warhay. I will now leave you in the very good hands of our moderator. Please give him a warm round of applause.
Very good. Well, good afternoon, everyone, and welcome to the afternoon plenary session. Thank you, Madam, for those kind words about this being a difficult after-lunch session. I hope it's not. You are awake, you clapped. That's a good start. So here we are, the title of the overall Global Green Growth Summit, Green Financing, Instruments, Innovations and Regulations. This is the plenary where we'll get into some of the ins and outs of this topic. Many of you who've been here and following this debate for some time around the world will know that there's been much progress in the past 3, 4, 5 years. There's been discussion on the different kinds of global taxes that could be put in place, bunker fuels, aviation levies. There's been an important recognition that public finance alone can't solve this huge scale of the investment challenge that we face if we are going to have a green growth agenda moving forward. There's been important investigations into the leverage potential of using limited public monies and public sector balance sheets more smartly to draw in private capital. There's new mechanisms and instruments under design, the Global Green Climate Fund, the BRICS Bank, some of which we'll hear about later, many more besides, national green investment banks. Yet at the same time, in those 5 years, it's arguably true to say that it's been a pretty difficult time if you're in the renewables energy industry space. We'll hear a little bit more about that from our keynote speaker. So what does this mean? What does this tell us about movement intellectually, politically, in the green investment agenda, and what's actually happening in the marketplace? How do we bring the two things together? And how do we find those instruments, innovations, and regulations that we need to really jumpstart this agenda at scale? Do we need any more reports, or is it now time for something else? We have a really super panel to talk you through these discussions this afternoon. I'm delighted to welcome you to them. And in no particular order, I'd like to introduce you to Mr. Michael Liebrecht, who's the Chief Executive of Bloomberg New Energy Finance. Michael, thank you for joining us. Michael will be kicking off the discussion with a 10-minute or so presentation with some slides on where we're at in this agenda. We have Mr. Vikram Wij, who's the Head of Climate Finance and Policy at the International Finance Corporation. Vikram, thank you for joining us. We have Dr. Jong Hong Sang from the Ministry of Strategy and Finance of the Republic of Korea, who's also an alternative member of the Green Climate Finance Board. Sir. And Mr. Amar Bhattacharya, who's the Director of the Secretariat for the Intergovernmental Group of the 24 on International Monetary Affairs and Development, and has been closely linked as well with thinking about this new BRICS Bank. So thank you for joining us. So that's the agenda. We'll have an opening presentation. We'll have some discussion amongst the group here, and then we will turn to you for some Q&A in the room. So as you are hearing the discussions and you start to get furious that what we're talking about up here is completely at odds with your own experience or your own understanding of the issue sets, or there's something very obvious that is not being said, then I would encourage you to not hold back, make a note, and raise your hand when the time is right for the debate, because we'll get into some pretty interesting discussion, I'm sure. We're here through 3 o'clock, so we have a good chunk of time to get into that. With no further ado, Michael, may I ask you to open us up with your thoughts? Michael.
Thank you very much. Thank you very much, Dominic. So first of all, I'd like to thank our hosts here today for inviting me, but also for giving so much prominence to the question of finance in the agenda of this Global Green Growth Summit. Before I start giving some context on investment in clean energy and some of the issues around that are faced by investors currently, let me give the broadest look at green infrastructure finance, green growth finance. In the world, across all relevant sectors, there's somewhere around 7, 8, 9, depending on definition, $1 trillion of investment in infrastructure or in hard assets. That's energy, that's in agriculture, that's in transportation, that's in buildings, that's in infrastructure of all sorts. And I think if green growth means anything, then surely what it means is that a very large proportion of that investment has to be rooted towards solutions that are softer on the environment, that have a smaller footprint, not just in energy, but across all of that infrastructure investment. And one of the first messages that I want to leave you with is that we really need to be thinking about, over the period of a decade or a couple of decades, numbers that begin with a T, trillions, not billions, and certainly not millions. You know, millions are cool, but billions are what we need to be starting with, and ultimately we need to be getting into the trillions. And that is of extreme importance if we really want to be talking about green growth in a meaningful way. I'm now going to dive into what we call clean energy here, which is renewable energy, energy efficiency, smart grid, power storage, not because it's the majority of those trillions, but because it really is at the heart of solving a climate issue and at the heart of greening our growth trajectories. So this timeline is investment in clean energy over a period of the last 9 years, since 2004 when I founded New Energy Finance before selling it to Bloomberg. And you can see that the investment flow grew very rapidly from around 50 billion, grew through to the financial crisis in 2008, then it went flat for a year at a figure around 180 billion, and then surged again with the green growth strategies around the world, also in fact led by the greenest of stimulus programs, which was actually here in Korea, peaked at around 300 billion and then dropped away by 11% last year. This is, as Dominic said, a difficult time for the clean energy, renewable energy sector. If you look at that on a regional basis, what you see is in the top center, Europe, which is really the cradle of large-scale investment in clean energy, with the help of green stimulus programs, with the help also of these solar rooftop programs in Germany and Italy, Spain, France, and so on, you saw a pretty continuous growth of investment. But finally, last year, with the resurgence of the Southern European financial crisis, that growth trend was broken. Top left, North America. There you can see much more on again, off again, a much quicker response to the financial crisis. So 2008, investment level drops. Then you have the stimulus programs, the grant program, the American Recovery and Reconstruction Act, and so on. And then you see financing flow. But again, last year, a drop as those programs ran out. Asia, top right, completely different story. Continuous growth from less than $10 billion in 2004 to over $100 billion last year in investment in clean energy. At the heart, driven by China. China is now the leading country for investment in clean energy. Something around 65 billion of the 100 and so is in China. But it's not only China. There's also India, there's also Japan, there's also many of the other countries in Asia that have shown growth even when the core traditional markets for clean energy have dropped away. Bottom left, Latin America. Originally, it was all about Brazil. It was all about ethanol. After 2008, it's less ethanol, less Brazil, and it's much more countries like Chile, Mexico, and also solar, biogas, small-scale hydro coming into play. And then finally, Middle East and North Africa in the center at the bottom has been traditionally quite a small recipient of investment in clean energy, but that's really started to change. And we see investments in Kenya, in wind. We see investments in Morocco, in solar. We see lots of announcements, more than actual investment yet, in places like Saudi Arabia around their plans to green their energy supply domestically for domestic use. But the big story here at the moment is South Africa. And in 2012, there was more investment in clean energy in South Africa as it completed some of its big reverse auctions for capacity, more investment in South Africa than in Brazil. So quite an extraordinarily rapid emergence onto the world stage. Now, what you see there, the top line, is investment in generating capacity, fossil generating capacity, on the grid. So this is the electrical grid, fossil capacity versus renewable energy capacity, the lower line. And what you can see is renewable energy now is around between 40 and 45% of all investment in electricity generation worldwide. So anybody who calls this alternative energy is about 10 years out of date, maybe 8 years out of date, to be charitable. This is large-scale stuff. In Europe, the proportion spent on renewable energy for electricity generation is already well over half, more like 65, 70%. So far, that's quite a positive story. You see the investment volume growing. It's only dropped 11% in the last year, which is less than the drop in the costs. And yet, this is the Renewable Energy Index that we publish, the NEX. You can see that the values today are approximately back where they were 10 years ago. This is an index of about 100 stocks. You can see it ran up during the years. Everybody was excited about clean energy, renewables, clean tech, Copenhagen, and then, of course, you saw it falling away, and it really hasn't recovered much. Maybe some signs of recovery this year. That's compared to the other main stock market indexes, the S&P and the NASDAQ. So a very difficult time for the investment community, which really relies on the valuations in the public markets as an index to decide whether they commit capital or not, particularly on the supply side, the technology providers side of the equation. The reason why the stock markets have fallen so far out of love with clean energy lies in the overcapacity. If you can see there, the bottom blue line is the demand in the market for solar and wind, and the top line is the supply, the capacity. And you can see solar, the capacity and demand grew very rapidly, wind less rapidly. But the red areas there is overcapacity on the supply side of these industries. That, of course, drives down prices, and it leads to consolidation in the industry. This is just a selection of companies. I actually got bored pulling the logos of bankrupt and restructured solar companies, and I stopped there. I could have continued for quite a lot longer. And this has created a very negative news flow in the financial markets. And the financial markets are not differentiating between the technology providers and the technology buyers. For everybody who's selling solar panels at or below cost, there's a power producer or a utility buying very cheap solar. So that's why you see some of the smartest investors, people like Warren Buffett, buying wind farms and solar parks. Because on the demand side, on the power production side, actually things are in reasonably good state. In fact, one could say robust health. and it's the supplier side, it's the technology providers that are in difficult times. But there are some other factors causing trouble as well. In the US particularly, very low gas prices driven by shale gas. We've probably all seen these pictures by now. Gas is so cheap that it's being flared. It's being flared at such a large volume that you can actually see the Bakken shale gas fields from space. They're brighter than Minnesota and Chicago. The shale gas price at $2.87 was an anomaly driven by the enormous volume of shale gas that reached the market without the market being able to absorb it. If you look this morning, the shale gas, or the gas price in the US is $3.80 per MMBTU. That's nearly double what it was at its lowest point. But still a very low gas price with respect to history, and a very low gas price with respect to the competitiveness of clean energy. And of course, shale gas is not just an issue in the US. As we know, there is the potential for shale gas in lots of other countries around the world, most notably, of course, in China. Now, the good news is that underlying all of this are dramatic improvements in the competitiveness of clean energy solutions. These are experience curves that you can see here. The top one is crystalline silicon, the bottom one is thin film. We're talking about 80% reductions in costs in 3 or 4 years, 20% in the last year alone. And there's no sign, even with that industry consolidation, that the price of clean energy is going to be going up from where it is now. We'll see that consolidation play out. Prices may stay flat for a while, but they will then continue to reduce. Never bet against the experience curve, particularly not in materials science or information technology around the smart grid and so on. In solar, it's reached the point that solar power on the rooftop is competitive with retail electricity prices in pretty much every sunny country right now. If you look at the impact across the developing world, and you compare the cost of solar for light and charging your mobile phone, the example here is Kenya, where kerosene costs $4 a week, and then you have to go somewhere where there's a diesel generator to charge your phone, versus if you've got a solar panel on your roof, it's $1 a week, gives you light and charges your phone. I'm involved with Sustainable Energy for All, and it's clear to me that we're going to win because the cost of these technologies is so much lower than it was, that lighting Africa, lighting across the developing world, anywhere where it's in the Sun Belt, is going to happen automatically because of the relative cost advantage of these solutions. Now, what it doesn't do is it doesn't tell you how to run a washing machine, how to run a television, how to run a fridge, how to get involved in food processing or light engineering and light industry, but certainly from the point of view of energy access, we're certainly going to see big changes in the coming decade. Wind is now competitive with coal. Modern coal, where you deal with the emissions, the SOx and NOx emissions, modern coal, where you have to pay the cost of your interest, wind is now competitive. And wind is competitive, the best wind farms with gas at about $6 per MMBTU. And you'll remember today the price in the US is about $3.80, so wind is not competitive without subsidies. But in Europe, gas costs $8, $10, $12 per MMBTU, and in Asia, as high as 15 or even 18. So wind onshore, where your grid can accept it, is already also competitive. So we're going to see this transformation playing out, but it's playing out in a period of unusual uncertainty. And if we want to talk about finance, we have to talk about uncertainty and risk. So here you've got a quotation from Fatih Birol, chief economist of the IEA, probably the best energy economist in the world. And he says the world of energy is facing a period of unprecedented uncertainty. And that is abundantly the case. So when it comes to clean energy, some of the uncertainty is actually self-imposed. Here you've got a map of Europe showing countries that have retroactively changed their support mechanisms. They have encouraged investors to put capital at risk to build wind, solar, and other resources, and then changed the rules afterwards on the yields that those investments will earn. The countries in yellow haven't quite done that, but what they've done is at very short notice, and without consulting the sector, changed their support mechanisms. So existing projects were protected, but all projects going forwards that are in the pipeline have been changed. This has a corrosive effect on financiers' willingness to commit capital. There's nothing that financiers like less than having the rules changed. More broadly in the energy industry is very, very good at managing risks. They've been doing it for a long time, whether it's drilling risk, whether it's risks of accidents, whether it's geopolitical risks, security risks. But there are new risks also on the horizon in view of the new technologies. Shale gas, I said that it is present everywhere in the world. First of all, we don't know how much it would cost. Will China's shale gas be extracted at $4 per MMBTU, the most competitive energy source that you could ask for, or will it cost $6, $7, $8, $10, $12, and therefore be more expensive than alternatives like wind? But also water. Many of the shale gas fields that are out there, even the substantial ones, particularly in China, in South Africa, in Mexico, North Africa, are in areas that are water stressed. And shale gas requires water and produces contaminated water. How this will play out, it is too early to say. There are also other new risks, cybersecurity risks, which the energy industry is now becoming much more vulnerable to as we move to smart grids and intelligent infrastructures. This is something also that causes uncertainty and therefore slows down flows of capital. And energy is no longer something that you do in a desert somewhere. Energy becomes something you do near to home. Whether it's, as you can see in the top left, shale gas fracking, whether it's Canadian tar sands, whether it's wind farms, you now need a social license to operate in a way that the energy industry is not used to operating over the past few decades. And this creates instabilities, it creates risks, it creates the possibility of popular backlash against energy developments in an unprecedented way. We're seeing the fossil fuel divestment movement in the US. It's jumped the Atlantic. It's now gaining a foothold in Europe. Where will it go? Nobody knows. But what we do know is that the divestment movement played a large part in the collapse of apartheid South Africa. This is potentially a very powerful and meaningful development. And the biggest uncertainty of all is, of course, climate change itself. With 80% of the world's economic activity either on the coast or in coastal plains, that means 80% of the world's energy infrastructure is also on the coast or in coastal plains. How does this play out? How should investors react? Now, in 2008, as all of this clean energy took off, and concerns about climate were at their peak, I produced this chart, which shows the 4 years of data that we had back then of investment in clean energy, growing from the 50 billion to, at that time, 150 billion. And what I postulated on the basis of all the work, all the modeling that we were doing at New Energy Finance, as it was back then, before the Bloomberg acquisition, was that it was possible to see the investment grow fast enough for energy-related emissions to peak in 2020, as the scientists said then and they say now that we need. We need that peak in 2020, and that's the investment flow that would drive it, taking into account experience curves, etc. And that is what we've seen. So we can now see that the sum total of all those uncertainties, all those economic forces, is that we are not investing enough in clean energy. Around the world, we're underinvesting by around a factor of 3. So it's not that we're not doing anything, but what we are doing, we need to do 3 times more globally. When it comes to investment north-south, we have a figure from Copenhagen of $100 billion that needs to flow north-south. And that's consistent with the figures you see here. We need investments of 600, 700, 800 billion in these technologies. The Copenhagen 100 billion, of course, relates to a broader set of climate solutions, not just renewable energy, energy efficiency, and so on. But let's say we needed to see something like 60 or 70 billion going into those solutions. What are we seeing? 8. So whilst the world needs to triple its investment in clean energy, the north-south flows need to be increased by a factor of around 8 to 10. So that's a key message to take away and to take through the next few days of deliberations. How do we do 3 times more everywhere and 8 times more north-south in these areas? One final thought that I want to add to that and leave you with is that when you talk about how to get more investment in clean energy, and it's the same if you look at water, and it's the same if you look at forestry or agriculture, the debates center on those sectors: the energy policy, the transport policy, the industrial policy, the technology policy, and so on. But I want to postulate, I want to state that we will not solve the problem, the factor of 3 and the factor of 8, by working purely within the energy sector or the individual industrial sectors themselves. We have to involve this second system, the financial system. There are barriers to investing in clean energy that reside within banking regulation, Basel III. There are barriers that reside within insurance regulation, within pension regulation, within the way pension trustees interpret their fiduciary duty, within the way ratings agencies work, within the way ratings agencies are used, within the way we calculate our national accounts, as well as in the energy system and the various support mechanisms there. So if we don't think about the system as a whole, including broader scale interventions in the financial system, then we will fail to finance the green growth that we all here today know the world so much needs. Thank you very much.
Thank you, Michael. That was a very comprehensive and interesting kind of overview of the challenge. And I think the quote from Fatih Birol is probably the one that's going to stay with us. This transition is playing out in a period of unprecedented uncertainty, and you picked up on that in your last couple of slides. And perhaps it's on that topic I might want to pick up the first thread of the conversation, and perhaps turning to Vikram. So Michael's hypothesis, based on the data of underinvesting by factor 3 overall, and the need to increase by factor 8 to 10 of these investment flows north to south, and the 2 cycles that he put up, that the financial system was just as much a challenge and a bottleneck as some of those different energy sectors or technology areas which perhaps many of us are used to working with. I mean, your job at climate policy in the IFC, you're at the center of all of these discussions, I imagine, between the public and private sectors. Can you perhaps enlighten us a little bit or give us your viewpoints? What's going on in the investment sector these regulatory developments, Basel III and pension funds. We've heard lots of talk about institutional investors and the challenge of the deleveraging of investment banks and such. Perhaps you could illuminate some of those areas for us and build on some of the topics that Michael has raised. Do we need to get into the guts of this system to solve this problem at scale?
Okay, well, thank you, Michael, for that wonderful talk. And let me see if I can do some justice to what you asked, Dominic. I think just working backwards from what you said in terms of the Basel III, we are beginning to see impacts. And forgive me, my comments are going to...
For those who perhaps don't know what Basel III is, maybe just a quick overview for those who might not be financially literate, just to...
Okay, I guess the simplest way of putting it is that commercial banks are required to allocate more capital for projects. It's a different rating on the risk side, and there are specialists here who will correct me, but it's basically resulting in deleveraging by commercial banks of investments, especially in emerging markets, because the capital they need to allocate in terms of covering that risk is now going to be much higher than what it was in the past. So with that shift, what we are beginning to see in emerging market flows is that commercial banks are not providing as much long-term financing as they used to, and as there was hope that they will continue to. So in some ways that's shifting the equation. It is also creating an opportunity, which of course has its own challenges to tap, with institutional investors, because institutional investors, and I think a couple of the more braver, bolder ones have said that they will become the long-term the banks, they'll substitute for banks in terms of providing the long-term financing. But the challenge is in terms of bringing the risk reward, and I think Michael may have referred to that at some point, in terms of how do you bring the risk reward in line so that institutional investors can actually start to finance this. I think there's no dearth of regulations that cover them. They have fiduciary responsibilities. They are responsible for their own pensioners and ensuring that the long-term obligations continue to be met. So it's not going to be that straightforward. The other issue, so that points to the whole, I guess, segment of de-risking instruments. It's not just about policy in terms of getting policy right, but how do you create the investment climate, and how do you put in place, whether it's using public resources like what the GCF could provide or others, de-risking instruments that are targeted to risks that are appropriate for the private sector to take, not a substitute for the risks that the public sector itself should be addressing. So there's that move. The other thing, of course, is this combination of leveraging capital markets domestically. Not only institutional investors from the north, but looking at domestic financial markets and leveraging those, perhaps even domestic institutional investors who might be more amenable in investing in emerging market development, their own country's development, than European pension funds who only have a financial driver and a greening driver, perhaps. And to complete that virtuous circle, you're going to need the deals to actually, even if you can come up with a structure where you have commercial banks lending in the shorter term and then packaging that and flipping it for, de-risking it in the early stage of, say, infrastructure, especially during the construction phase, flipping it over to the long-term investors, the pension funds, you're still going to need, and if we get lucky with that, you're still going to need the deal flow to feed that beast, so to speak. You're going to need the absorption capacity. If the GCF comes to scale, what did you say, Michael, $8 billion? If the currently north to south flows? Currently, if that goes 4 to 5 times also, not leave alone 10 to 12 times, is the absorption capacity exist in the so-called south in terms of absorbing it and leveraging it? Maybe we can come back to the whole leverage issue later, but I'll stop there for now.
Fascinating. So not only is this challenge around some of the activities within the institutional investor, but also, even if all that were to be sorted, the ability of some countries to literally take on that scale of investment in these green energy projects. Dr. Yong Hong Sang, from a public policy perspective, you represent the Ministry of Strategy and Finance, and you're also helping to architect a new global mechanism, the GCF. From a public policy construct, have what you heard, does that resonate with you, or what other drivers do you see from the public sector side that you think are important to drive this agenda forward at scale?
Okay, I think for the public sector, some fundamental issue is to make people understand the urgency and the seriousness of climate change, and to make them support for some initiatives to address the climate change issue. Because I think several issues related to climate change, for example, carbon pricing or reducing fossil fuel subsidy, in many cases they have political obstacle. Many people, actually experts, they understand and they support, but politically they cannot get full sufficient support. Then it is stuck in implementation. So I think one fundamental issue is how to make people better understand and support for these climate change issues. And in that regard, I think GGGI or the newly establishing GCF can make some important role.
Thank you. So far, we're building up a kind of a dissection of the problem as set out by Michael, and building upon that. So in your minds, start thinking about some of the solutions at scale that you think one could focus on. But whilst you're thinking of that, and I encourage you in the audience to do so too, Mr. Bhattacharya, this sort of feeling that we have these systems at play, the financial system, the energy system, we need to get under the skin of them and perhaps rebuild some of the architecture. The work that you're involved with, which includes perhaps examining how this new BRICS bank could help, does this resonate with you? Are you exploring similar themes in this exploration for how to scale investment in the green growth space?
Before I do that, if maybe, since I'm speaking a little bit from the official South, if I could say a word of context, because I really believe that we are at a kind of a historical inflection point at this point in time. If you look at the last 60 years, developing countries and developed countries were growing at roughly the same rate. But beginning in the last decade, there has been a fundamental divergence, with developing countries now growing significantly faster, and the crisis has only accentuated this. This is not just a story about China and India. Today, 7 out of 10 developing countries are growing faster than the developed world. And before the crisis, 90 developing countries were growing faster than 5%. It's unprecedented. So when we talk about green growth, we have to remember that growth is actually, in a sense, accelerated very significantly. However, that growth has been associated with rising emissions. Emissions increased from 1% in the decade of the 1990s to 3% per annum in the last decade. So, and now emerging markets and developing countries account, as you know, for 2/3 of the global emissions and all of the incremental emissions. So getting it right, as was pointed out, is extremely important. Okay. Now, there is on the other side, I think, a unique opportunity. Why? Because the bulk of the incremental investment in the world is now being undertaken by the developing world. 2/3 of investment spending is by the developing world, and it's much easier to deal with incremental investment than it is with fixing the capital stock. So if you could make this investment as green as it could be, we would make a big impact on the world. Second, as was pointed out, there's a huge amount of innovation taking place at this point of time. There are a lot of co-benefits from green growth. So if we can bring this together, we would do very well. So that's the story and opportunity that Michael mentioned, and he pointed to some constraints on the private sector side. Let me look at the mirror and point to some constraints on the emerging markets and developing countries side. The first constraint that's very important for you to remember when you talk about green growth and the big requirements is what I would call an affordability constraint and an intertemporal constraint. You have to remember that the per capita incomes in countries like India is $2 a day. It's very difficult to finance a lot of this with that level of low income. And second, the payoff that you are going to get is very long term. So in financing, we have a fundamental constraint when it comes to financing in emerging markets and developing countries. Second, even if the financing were there, the policy and institutional constraints are very large. This is, as was pointed out, not just the traditional policies that we talk about, but the fundamental policies about putting together good, viable, bankable projects, and the policy environment that will ensure that they produce the returns over time. And that's a huge shortcoming. Third, access to technology, the best technology. It's there, but not just having access to it, but to be able to use it is a fundamental constraint. Fourth, if you look at the world we are in, we are already seeing the impact of climate change. Where is it going to have the biggest impact? It's going to have the biggest impact on the developing world. So that again is a disproportionate cost that we have to keep in mind. But probably in terms of the financing issue, what Michael said is very, very important. The biggest needs right now are for overall financing of infrastructure. The estimates that we have prepared with the GGGI suggest that investment needs for infrastructure will have to increase from something like 800 billion per annum to more than 2 trillion per annum in the coming decade, if we are not just to meet the growth objectives, but the sustainability objectives. And against that backdrop, coming back to where the question you asked, the global financing architecture doesn't meet the task. Not only in terms of the scale of financing, but as Michael pointed out, particularly with matching the risks that are inherent in this kind of financing. And let me just tick off the major sources of finance and show and highlight the problem. Public finance, absolutely central, but you cannot just run public finance in this new world of debt fetish, if I may call it that, and also with the world of management of contingent liabilities. You just can't use public finance in the way you have in the past. Second, if you look at official development assistance, it has never been really oriented towards infrastructure, and the scale that you get is very small. Third, MDBs, including the entire system. Of this 800 billion, they provide less than 3% of the financing. Very small amounts. And they are constrained by their capital, by their policies, by their instruments. So there's a need for major change. Private finance is hugely underutilized, but as Michael pointed out, long-term private finance fell 40% after 2009. Huge decline in private finance. Yet we know there are new sources of private finance, and there are sovereign wealth funds, a lot of things that can be done. Okay. Against that backdrop, we need to think about new instruments that can catalyze change. And I do believe that two new instruments that have been put on the table that can play a very powerful role are the Green Climate Fund, and the second is this new development bank. It's up to the BRICS countries to talk about the bank, but as a kind of, as somebody representing the broad interests of emerging markets and developing countries, its role as a potential agent of change that could be very, it's really to deal with the, to ensure that we are pushing the deal flow. It's to deal with issues of project preparation, policy constraints. It's to be able to do this leverage. It's to be able to change the governance of the international system, which has been dominated in some sense by one set of players. We need to open it up. So it's that catalytic role that I would argue is most important for these new institutions. And one of the things that is striking about both the Green Climate Fund and this new development bank that's talked about, it's turning the governance debate completely upside down. So I think there is a great moment of change and possibility right now. And I think, in a sense, Michael's world of private change could be complemented with a world of public change.
Very interesting. Thank you very much for that overview. Just a quick follow-up question. If we're at an inflection point, as you suggested in the opening passages of your thoughts, do we sense that more ownership over addressing the problem and mobilizing domestic and within the South financing to tackle it will start to become a theme as part of that inflection point, which is a different kind of shift in the politics of the discussion we've perhaps had to date, particularly on financing?
Yes, I mean, my view is ownership is key even in finance, and let me explain what I mean by that. Why is it that the World Bank or the regional development banks or the Latin American Development Fund have such strong credit ratings? Everybody talks about capital backing and creditor support. But in my view, the most important reason is actually borrower commitment. In two ways, not just to pay back, but to resolve problems and issues as they arise. And particularly in infrastructure, that's extremely important. So this borrower commitment and the ownership is critical. If you look at the World Bank today as a development institution, it's absurd that the developed countries have a majority ownership in that institution, or that the head of it should only be an American. So if you think about the new BRICS Bank, it should change that discourse in a very fundamental way, not just about ownership, but also about responsibility.
Very interesting indeed. They certainly are times of unprecedented uncertainty and change. I'm going to come back across the panel a little bit on this with now some thoughts on, so if this is the situation, what are the answers? We've started to get there perhaps towards that with the BRICS Bank, but before I do that, I can't resist. Vikram, you work for MDB, you are part of the World Bank Group. How does that sound?
You're not going to bait me into answering that, are you? I mean, yeah, and not for a live telecast, from what I was told. I think without actually directly answering that question, Dominic, and you'll excuse me if I don't, I think some of the points he makes are actually very valid and on the money, because one of the issues is, does the BRICS themselves in this context, or the emerging markets at large, it's in their own self-interest at the end of the day to move investment into the broader green sustainable space. So to the fact that they manage their money and leverage it and deploy it in a manner that they find suitable is actually is very interesting. I mean, there's a similar effort underway, and I don't know too many details around it. Number might is around the infrastructure fund that the bank group is putting together. Again, lighter touch of the normal sort of approach that the World Bank Group takes to moving more capital specifically towards infrastructure finance. But so that's for sure. The other issue, of course, around public monies is that transformation is going to require that it effectively be fit for purpose. And I think the other point he makes around the GCF is critical. It may be, I think we are hoping, a lot of us are hoping that we'll get past some of the early teething issues that the GCF is having currently, but that within the next couple of years it will actually become a force to reckon with. And the only way it becomes a force to reckon with is if it breaks the mold of past approaches to providing public finance or the concessional money, but actually looking at what is the transformation it is hoping to achieve and effectively being designed to suit that. And to that extent, I think, again, it goes to the heart of governance, it goes to the heart of the business model, and forgive my bias, it also is key as to how the private sector accesses that money and what is the interplay between the governance of the fund which is managing public money and the clarity and the predictability that the private sector needs sooner rather than later. And that will start to become key as well.
Interesting. Thank you. Mark, I'll come to you in a second, but Dr. Young Hong Sang, that's quite a tall order about what the GCF needs to achieve, and you more than anyone I know will be aware of so many people hoping for an innovative design and an institution that feels new and that can punch through some of these bottlenecks and challenges and really have a transformational impact on the flow of finance, particularly for developing countries. How are things going?
First, let me note that I'm not in a position to represent GCF here. Just I'm an alternate member for the board. But in my view, I agree that GCF should function as some change initiator for the whole climate financing system. Just a few points I want to mention. One is that GCF, its objective should include, incorporate the poverty reduction issue together with climate change. It's a quite significant scale, and if it is used just for climate change, actually some donor countries, I feel that they are too much focusing on just climate change. But if they ignore the poverty reduction MDG or related economic growth, then developing countries, I think the GCF cannot include developing countries very on their voluntary participation. Then we cannot expect some effective implementation of the projects. So the climate change is most important. Lower carbon framework, shifting to lower carbon framework, including adaptation. Of course, that is the main point, but it should be consistent or include some aspect of the poverty reduction aspect. That is my one point I want to mention. Another one is that the process of policy making and allocation of resources and implementation of projects. In those process, I think the process should be consultative with developing countries and business. Developing countries, they should have kind of ownership and participate with some responsibility in the process, and their voice should be reflected in the GCF's policy shaping and implementation of the projects. Then we can make some real changes. That is my view. And also the business are the actual actors in implementing projects. So they have they confront several difficulties, especially in developing countries. In developing country situation, they might have a very poor legal system, or if they have even if they have good legal system, it might not be effectively implemented, and some security issues, several issues. So based on each project, we need to look very closely what hinders the fluent flow of private sector to developing countries. then I think GCF can make itself as an effective institution for climate change.
Thank you very much. I'll be looking to see if there's a couple of questions from the audience in a second or two. Michael, this is kind of interesting because nobody has disputed, if you like, the landscape that you set out. You got confirmation, you know, from architects deep in the international mix on the need to understand and work with that financial system more effectively. We got confirmation of the power of the south-to-south flows and the unlocking of capital within that space. Nobody has disputed the scale or the size of the challenge or the potential to overcome it. Yet you can sense, perhaps from some areas of the agenda, a public sector response to the challenge in terms of these new mechanisms, these new institutions, and in some cases the absolute need to have those new institutions have a developmental role as well as a financing role. Given that you are curiously kind of unleashed from any of those developmental constraints and other public sector angles, if a question, so what is to be done, was thrown to you, what's your answer? Would you create something?
So, first of all, let me say that what I'm hearing I like. I mean, I like the work the IFC does, I like that there's going to be the GCF, and I like the idea of the BRICS and using the south-south flows. I'm just very concerned that we're not seeing a solution that's going to work at scale. You know, there is this torrent of investment that's going into fossil fuels, that's going into the emerging middle classes wanting to buy cars, and so then they're going to have, there's all of the refining capacity, there's all this non-green growth that's happening, and simply, you know, adding a little bit of this or a fund to do a little bit of that and so on the edge of it without actually affecting that mainstream torrent. You know, we will be here in 10 years saying, well, the GCF is good and it's funded 8 billion, 20 billion, 26 billion, whatever, but it's just not the right order of magnitude to deal with the 6, 7, 800 billion per year, the north-south of 100 billion and so on. When I listened to the design of the Green Climate Fund and the constraints that were put on it right from the beginning about consultation with the recipient countries, about the fact that flows had to be predictable and so on, the private sector is essentially going to, you know, the only role that they will accept in that is to take some of that money and be the implementing agency. No private sector player is going to put money into the Green Climate Fund. So that sort of, some of the original ideas of leverage are simply not going to happen. And you know, my concern is that the donor countries are simply not going to put funds into it at a scale to meaningfully impact the problem. Now, there might be some leverage, and you might get to a footprint of, let's say, including leverage, 50 billion a year, including leverage. But the problem is much, much bigger than that. In fact, even 50, I would suggest it's probably going to be more like 20 billion, including leverage. And it's just not the order of magnitude. And so that concerns me. And I think when your question wasn't what I thought of other things, it was what should one do. I think that
you're hunting for structural change.
You've got to be intervening at structural levels. You've got to find a series of interventions, each of which can deliver a sort of $50 billion annual payoff. A $50 billion one-off in 10 years is just not big enough if you're serious about green growth. So $50 billion annual payoff interventions are going to look like figuring out, I think that the south-south flows potentially can get there. I think that doing something with pension funds, with sovereigns, can get there. I think some interventions in the capital markets in terms of the way we regulate and the roles of ratings agencies, you know, they feels like if you could make a big intervention, that could have that sort of large-scale result. But I think that's sort of what I'm looking for. I just want to come back to one thing that Mr. Bhattacharya said, which I think is incredibly important, since this is a discussion about PPP. This idea that the MDBs, their one of their roles, and I would argue maybe their primary role, is not as a provider of capital. There's capital everywhere. The world is awash with capital. But it's in this idea of actually changing the risk-return equation, that by being involved, actually reducing the risk. So before you start dividing up the risk, you've actually got some players whose involvement reduces the risk. And I think that's something that, again, that feels like a big chunk, one of those 50 billion a year plus, really worth going after that and seeing, well, how can one scale that, and how could the GCF also achieve those de-risking, so that with small amounts of money but the right people around the table, you've actually able to increase the attractiveness of the green solution vis-a-vis the dirty solution, which maybe doesn't come with such big influential friends.
Interesting. Okay, so this, I would imagine, will have provoked a few of you to have some thoughts. So please raise your hands if you've got a question for the panel. And then when you do speak, tell us who you are and who or what you represent in as few words as possible. Anybody got any? Yes, you, sir.
Hi, thanks. Simon Zadek, 3GI. I wanted to test Mike's appetite for scale, and perhaps all of our appetites for scale, because I might completely agree with you that the stuff we're talking about in the climate space is of the wrong order of magnitude, however smart we are about blending A, B, and C together. And so just two or three options maybe that takes what you said further that I want to see whether you think makes sense. You know, what about revisiting the underlying structure of the fiduciary responsibility of institutional investors? You know, let's go back to square one. Let's not work out how to seduce them. Let's change the rules of the game. Number one. Number two, you've already mentioned, which is credit ratings. You know, today's sovereign and corporate credit ratings do not count natural capital. They do not price carbon, and that can be regulated. And now would be a good moment where credit rating agencies are on the back foot. You know, that would be kind of a second piece of the story. And number three, the mandate of financial regulators. The current debate about macroprudential is finally an opportunity to extend the mandate of financial regulators to give them responsibility not only for the resilience of financial markets directly, but the resilience of the systems within which financial markets exist, which includes the green system within which the economy exists. You know, we have real pathway options. How far should we be going? How much appetite do you have? Thank you.
Thank you. Any other questions from the floor? There's one down. Oh, yes, down here. Thank you.
Hi there. I'm Alex Bowen from the Grantham Research Institute at LSE. I wanted to ask about investment in dirty energy. It seems to me that while there are strong incentives to continue to invest in fossil fuel, you're not going to get the switch, the transformation that we require. And I wanted to ask the panel what they thought of the recent arguments laying out the importance of overvaluing fossil fuel stocks, overvaluing unburnable carbon.
Okay, let's, there's kind of two sides of a similar question. Why don't we kind of tackle those? I'm glad that this came up, actually, because this issue of financial market regulation was something that, you know, I thought that we could play around a bit, and you mentioned a sort of structural issue. This, I believe, sir, is work by the Carbon Tracker initiative, which suggests, for those who haven't seen the report, the top 100 coal companies and the top 100 oil and gas companies, which were worth about $7.4 trillion in February of 2011 when the report was written, have fossil fuel assets which represent 745 gigatons of CO2 emissions if they were to be used, which, according to calculations from, I think it's the Potsdam Institute, is more than the carbon budget that we have left to 2050, if we are to keep within a safe range of global warming. What we have left is 565 gigatons of CO2. So if this were true, this seems quite compelling and builds on the first question about is that something that can be taken back to the financial markets and to create a new kind of regulation to unpick this problem? Maybe, Vikram, this is something you might have a thought or two on.
On the issue of, I was thinking about the unburnable carbon issue when Simon was talking as well. And I'm not so sure you can regulate your way out of it. I mean, we can definitely debate that. But the issue,
why not?
Was very simplistically, I think perhaps it comes down to this very simplistic issue of getting the prices right? I mean, if we don't have the prices right, why don't we have the prices right? Yes, it goes to the heart of the fossil fuel subsidy issue, it goes to the heart of having a price on carbon or whatever the moniker is for it. Why are these companies valued that high? It's probably because the investors don't have a confidence in the alternative, and that the alternative would be that this sort of the unburnable carbon is not truly unburnable. It's because there is no ambition, there is no confidence in the political ambition that we will achieve some sort of a global agreement, or at least, if failing that, at least a binding agreement amongst the major emitters. It probably reflects the fact that there is no shift in policy or no foreseeable shift in policy that is coming in terms of that. And the third thing goes to the heart of, and maybe you mentioned the student movement, but the whole divestment movement, and are the institutional investors who themselves represent $70-odd trillion worth of assets, are they ultimately going to start to drive this in terms of seeing what their investments are at risk with? So,
Mr. Bhattacharya, this sort of discussion around a structural set of issues and trying to pinpoint some areas which could see transformational change, and here's this issue about regulation in the capital markets and such. How does this play to your ears? Is this something that's also worth looking at?
Yeah, well, I mean, as particularly as I was listening both to the intervention from the floor, also to Michael, it seems that you have to move at multiple levels, and it's worth sort of assigning some accountabilities. So clearly, you need a global agreement that prices carbon right, one way or the other. Unless you have that, this isn't going to work. So I mean, I fully agree and strongly agree with that point.
This meaning the mobilization of the finance we need at scale?
Or, getting the kinds of transformation.
Right.
Okay. Because why, it goes back to the issue of why is things being priced so high? Because people don't believe the carbon price, future carbon price. So you have to get the prices right, which could be done through pricing, could be done through regulation, cap and trade, whatever you want to talk. But the thing is, we need a global commitment to a regime which binds behavior of both public and private agents. First point. Second is talking about solutions to scale. So my view is ultimately the unit of account is the country. It's the countries who have to make green growth a fundamental part of their development strategies. Unless not just the China's, India, Mexico's, etc., but every country, Ethiopia, Guyana, as we heard, make green growth a central platform, you are not going to actually have that solution at scale. It's not going to come just autonomously. So you need country commitment and country capacity, political will. Third, you need, in some sense, the institutions that are intermediaries in this process. It's not just the direct finance, but that are able to connect. And that's what you had created the MDBs for. And then you need an informed private sector, including informed new investors. I mean, it's encouraging that pension funds are beginning to set up outfits to look at infrastructure as a new asset class. But we are just at the beginning of that. So you also need an informed private sector and an innovative private sector. So I do think that in thinking about solutions, it's worth thinking about who. And I would say you have to think about the global players, where we have the worst problem because we don't have the political will. We have a lot of action on the country side, and it is replicating. I think we have to step up on the kind of intermediary side, and we need to rethink the private sector.
Interesting. Michael, this is a curious beast, isn't it? Because if you tweak the ear a bit, we'd sort of go back to first principles of, you know, we need a global accord, we need a price on carbon, and unless we have that, nothing else can happen. And yet we started off in terms of the potential for innovation and looking perhaps at the finance sector per se, as some of the suggestions from the floor were at. Do we kind of always just go round and round this one, or how do we bite into the bullet of it?
I don't think we do, because I think that the primacy of the global price on carbon discussion, I think I don't buy into it. I think that what we see is that countries, maybe not adequately yet, but they are dealing with this issue. Against, you know, if you believe the classical analysis of the tragedy of the commons, then nobody should do anything until there's a deal. But the fact is that countries are doing things, whether it's the developed world, whether it's developing world. What we're actually going to see, and we are seeing, is thousands of different prices of carbon, which are set in taking into account the co-benefits or the co-disbenefits of the various sectors in which they play. And I think that we need to be realistic that that is what the future looks like. It's a much more nuanced, it's much more confusing, but that is what we've got, and that's what we will have. And by the way, that's most likely, well, that is far more economically efficient, because instead of saying, well, you have one price of carbon, whether you're doing carbon capture and storage or deforestation or energy efficiency or renewable energy, those things happen at different prices. So if you have one price, you have monstrous transfer payments, which will be politically, economically unacceptable. But so I just don't buy the price of carbon. But also, what I see is that so many of these solutions are economically viable right now. Distributed energy solutions in the developing world for those without energy access, I went through in my opening remarks, and so many more would be economically feasible, even if you can price in just some of the other inefficiencies like air quality or impacts on water and so on. So I think that this idea that we hang everything on some outcome that will take effect in 2020 is incredibly dangerous. If I could, I'd like to come back to the two questions, and Simon Zadek's question, I think, takes me back to an argument I had with him at the World Economic Forum. I have to concede, Simon, you win, that yes, there do need to be these interventions in things like pension fiduciary duties and so on. Natural capital I'm nervous about. What I do know is that we need to have some idea of national balance sheets so that we're not, for instance, in the US, selling coal from the Powder River Basin at some unbelievably low price, which then ends up in Europe driving up the carbon and actually shortchanges the American people to an extraordinary extent. So we need some idea of resolving that. But the question about the unburnable carbon and could we regulate, to me, the issue is similar to the subprime, where you've got the macro instability in the system. You look at any individual balance sheet and you say, do they have those assets? They do. What's the oil price? Well, we know that. Therefore, yes, we're a ratings agency. We're happy. But you've got to look at the systemic problem that says if we continue funding those things and extracting and burning those things, then something really bad is likely to happen, at which point those investments are not worth what we thought. And by the way, it could happen a lot sooner. It could just be a bad hurricane season in the US that changes the politics, and suddenly you're talking about a carbon price or a carbon tax or some other solution. So I think that at the very least, there's an issue of disclosure of risk. At the very least, one can't simply look at those instruments and say, well, you know, the cash flows based on current legislation are what they are, and therefore we're going to give it a AAA or a AAB or whatever. I think also, though, that the financial regulator has a responsibility to think about the resilience of the system in the face of new and unconventional threats, and not just protecting it against the last financial crisis, which was a liquidity bubble-driven crisis. But what's the next crisis likely to be, or what could the next crisis to be? And I think if you look through the resilience prism, then absolutely some form of regulation. And I'm going to be honest, I don't know if anything beyond disclosure is feasible, but I certainly think we should be having that discussion, because right now I can tell you the system is not resilient, and we see flash crashes, we see all sorts of things going on in the financial sector, and we're not protected against them. So I think we do need to look at those questions again.
Well, listen, thank you very much. We're just on the hour, 3 o'clock, which is when we were due to close. So what I might do is just see if across our panel there's any final thoughts you'd like to leave our audience with, who are probably thinking, yeah, this now sounds quite complicated. There doesn't seem to be a silver bullet. Some of these new ideas for innovation and funds at scale sound pretty interesting, particularly with the South-South flows of finance and the new way of looking at the governance and deployment of funding and technical assistance and support and such. There's a wealth of experience and knowledge that exists within some of the existing multilateral institutions, and an enormous amount of work on the leverage capabilities of different structures, which we didn't even get into yet. That the GCF will play an enormously important role, combining both the climate change, adaptation, mitigation, and development aspects, which we need from an institution in the space. And yet, there's all of this other stuff at the structural level in the financial sector. There's a disclosure of risk at minimum. There's the roles for the financial regulator to take on a different kind of journey than they've been on before. One perhaps has to go back to some of these fiduciary duties of the institutional investor community. Still a lot of work to be done, even though we feel a lot of work has been done. That's a conclusion that I start to draw from this discussion. I invite our panelists, if there's any further thoughts from you. Mr. Bhattacharya, Dr. Hong-Sang. Sir, any final thoughts from your side?
Okay, very short one comment. So we are thinking about private sector investment to climate change projects, but if we think about carefully about the different levels of developing countries, I think lower pace developing countries, maybe they cannot receive some private investments because they might have legal system issue or some macroeconomic stability, financial regulations. So especially LDCs or SIDS. For those countries, I think mostly anyway, public sector, public funds should handle those projects.
Thank you. Mr. Witch?
I don't disagree with Michael in saying that we don't need or will ever have a single unified price of carbon, but I think pricing carbon, whatever the asset, there are going to be a plethora of assets, both on the liability and asset side, and they can be priced differently, but we still need something to drive that. And I think while a lot is economic, we really need to look at incremental risk over incremental cost. I think a lot of the drivers so far have been based around transfers and financing around incremental cost, but whether it's incremental risk in terms of unburnable carbon, in terms of institutional investor portfolios, in terms of green growth, in terms of resilience, we need to be looking at the incremental risk issues and seeing how we can channel and use the flows that are hopefully coming to address those more than looking at the cost side of things.
Very interesting comment. And so we end where we began. Michael, the last word?
It's complicated. No, but I think that's this is the right discussion, okay? Because finance is an ecosystem, and building ecosystems is hard. If you want to build even even simple-looking ecosystems like prairies, it actually turns out to be very, very difficult. And you have to get your key species, whether it's a BRICS bank or a GCF or the MDBs, you have to get them right. So I think that if we're having the discussion about the ecosystem and how to shift it at that scale, then I really, really welcome it, because that's not one that happens on any other forums. And so I return to where I started saying it's great to see finance on the agenda here. So thank you.
Well, ladies and gentlemen, thank you, and thank you to the panel. Here you have the first in perhaps a new theme series of ecosystem discussions about the financing challenge to tackle green growth. If you'd like to join me in a round of applause for the panel, thank you very much.